global meltdown as well as problem on the border. Do you think this can take us much slower?
I think geopolitical situations are a bit unpredictable and clearly have direct impact on the market and the sentiment. Should the geopolitical tension continue, I guess the markets will remain a little depressed. My own view is it's perhaps a one-off response, and I think good sense will prevail where it must prevail, so that this issue can come to an end and the markets can get back to being normal and hopefully bullish.
Okay. But do you get the sense that you could use this situation to buy into stocks, or would you think that value is already stretched?
Well, our view is that the markets are already expensive, very clearly. Having said that, there is so much liquidity in the world, Lata, and India seems to be the one isolated destination that still is an attractive destination, certainly within the emerging markets, that I don't think basic fundamentals are really determining valuations today. Valuations are as much determined by liquidity and India's uniqueness as an attractive proposition. And so long as the liquidity continues and India continues to remain a more attractive destination, you will continue receiving capital. I would believe that at every sell down, there is an opportunity to buy. Having said that, let's not forget the market is truly expensive looking at the earnings today.
Okay, finally, since we are talking about valuations, CNBC TV 18 did a poll of a wide swathe of CEOs, 50 top CEOs, and the result we got was that 80% said FY17 is better than FY16, and 44% said that they expect double-digit earnings growth. Now, what's your comment on basically the quality of the economic recovery? How good will it be in FY17 itself? Is it a V-shaped recovery?
I think there is no debate that FY17 is a better year than FY16. I think what's really happened is that government's support to direct benefit transfers is fully kicking in. If you look at the two-wheeler recovery in the last 3 months, and I always say, look at the two-wheeler recovery, and if it's sustainable and over a period of time, it's perhaps the best indicator on where the economic demand is going. I'd like to believe that in the next quarter, which is the October to December quarter, you'll see even better and stronger demand. And I believe the recovery in terms of better sentiment and higher demand and higher consumption is across board, which effectively means that at least one engine of the government is firing strongly, of the economy is firing strongly, and that's the consumption engine. What worries me even today is that with all the recovery, we still don't see an uptake in the investment cycle. Now, that is perhaps because there is already so much capacity. We need to see this demand sustain itself for a period of time before people talk about capex. We also know that government's sustained attack on black money is creating, at least temporarily, an environment where people are not sure whether they want to remain invested in India long term. It's a short-term phenomena. If the demand continues to sustain itself, I think the investment cycle will come back, and when the twin engines start firing, then you will really see double-digit growth.
So investment in FY18 or 19?
A little difficult to predict. I would say certainly in 19. The only challenge is that 19 would be an election year, and we've seen that around the election year, doesn't matter which geography, investment sentiments tend to be a little weak, in which case, perhaps 20.
Will the cost of money matter? How many rate cuts?
Cost of money always matters, but right now the equity markets are so bullish and so strong that every good company is able to raise enough and more capital. And so long as the equity markets continue to remain bullish, there will be lesser and lesser dependence on the banking sector. The banking sector has a little more distance to go before it is fully revived. The stress is fully addressed. And while that continues to go, there will be a rate cut. There is no debate. There will be a rate cut sooner or later. Whether that is one rate cut of a relatively larger piece or two rate cuts, don't know. But I would say over the next 12 months, a 50 basis points reduction is certainly welcome.
Mr. Wadhwa, thank you very much for